afternoon, financial professionals. I'm Steve Walker, and with me we have Rod Crandall, both of us with E4 Insurance Services, welcoming you to the Brew, building relationships every week. Thanks for tuning in today. For those of you joining the Brew for the first time, welcome. We like to start the Brewcast by celebrating today's national days. We've got a couple of odd ones, to say the least. We've got National Moldy Cheese Day. I'll say that's in in honor of our Wisconsin office, since it's cheese related. And then we have National Stop Bullying Day. Good reminder not to be bullying anybody. On today's Brew, we are continuing October's focus planning series, Selling Your Business. Rod Crandall will be discussing the role of private equity in business succession planning, drawing from experience sourcing companies for PE purchases. He'll also be discussing the increasing consolidation across industries and the rising competition for deals, leading to higher prices and more creative sourcing strategies. We encourage you to use the chat box or raise your hand to ask any questions. And all attendees are entered into a drawing for a CE voucher and Starbucks gift card that we'll announce at the end of today's Brewcast. So we thank you all for tuning in. And Rod, great to be with you today, and excited to have a conversation for a little bit. Why don't we just start off with your background and experience in the private equity world?
Yeah, thanks. I will start there, but I got to tell you, I didn't know it was National Moldy Cheese Day. I'm going to not take that personally that I'm your guest on that day. But I am a big blue cheese fan, and I imagine one could bully another with moldy cheese if they weren't such a fan. So interesting that those are the days here today.
Oh,
yeah, so I'm here. I'm certainly not a private equity executive by any stretch of the imagination. However, I formed some years ago what I consider to be a sourcing group for private equity specifically. And what we did is we pulled together a group where we pulled in around 500 different people, what I call service professionals, bankers, accountants, attorneys, consultants, wealth advisors, insurance people, commercial real estate brokers, et cetera. And what we did is we developed relationships with about 20 private equity firms, and we got those firms to sponsor breakfast meetings for us, and they helped educate us on the lay of the land in private equity. And what they really wanted more than anything is they wanted quiet introductions to companies looking to exit their business. And so I'm doing that less actively today than I have in the past. But in the past, we were able to show about 20 private equity groups around 100 different companies that wanted to exit. And in fact, one of the private equity firms bought one of the companies that we referred them to, and they bought them for almost $200 million and paid me and my team a large seven-figure fee. And so that got a lot of attention for myself and for my group in understanding, wait a minute, what was that and how was that and why was that? And so today, I'm hoping to just share some of the anecdotal wisdom that I gave. But again, I'm in no way an authority. But with that said, I do have some experience being around these types of folks.
Well, I think just you get that kind of revenue stream when you get a couple of commas in the paycheck, and like you said, it's going to raise some. Oh, what in the world is that? And like you said, I think you've talked about your group there, kind of your study group, your confidant group, and things along those lines. And I think it's just a great reminder for our advisors is, again, it's not just insurance. I mean, again, that's the bread and butter day to day, but keeping your ears to the grindstone on things like this, it's not going to be a everyday occurrence, but you hit one of those every now and again. It's a nice add to the old paycheck.
Yeah, right. One more thing to add on that is that while my focus was getting folks in and identify assets for private equity, something somewhat unexpected happened, which is it ballooned up my network very large and really helped my insurance business. Because what I found generically is that it's a lot harder to get people excited about talking to an insurance person than it is getting them excited to talk to private equity folks. But when I was the person who put them together, now all of a sudden they go, well, who are you and what do you do? Oh, well, I'm glad that you asked. And so I was able to develop some significant relationships through that that actually helped me drive my insurance practice as well.
Absolutely. Being a connector, asking questions, getting the right people to the table, and it may or may not pay off right away day one, but long road you're going to have a meaningful career and have some fun making money doing it too. So
yep, exactly right.
how about one of the things I'd written down and kind of personally had some questions. I know we've talked with a couple of opportunities out there in the past as well, but as far as the type of capital that exists in these private equity purchases, what different types of capital are out there that you're seeing in these PE purchases?
Yeah, that's a good question. Private equity is sort of like a category, right? And you think private equity is just one thing, but it's really not. They have sort of strata based on what kind of capital is being deployed and what is really their goals. And so big picture, how I understand it is, you first got sort of venture capital. You've probably heard that. And venture capital is basically really high risk, but maybe really high reward. And so these are early stage companies. They might have little to no revenue when they start, right? And so there's specific type of capital that isn't going after any one of those deals. They're going after 10 or maybe 50, expecting one or two to really go to the moon. And
Yep.
so there's a high failure rate there, very speculative in nature, and a different type of buyer, right, than some other sort of tranches or other types of capital, like a traditional private equity firm, which was primarily the folks that we were sourcing for, is more traditional private equity. Well, what do I mean by that? Well, traditional private equity usually has a 5 to 7 year hold period. And the reason for that is that they go raise money in their funds, generally from institutional investors and municipalities, and they have to effectively return that invested capital at some point to show a return. And so that means that they literally have to have an exit in mind the moment that they buy it. And generally, they want to hold 5 to 7 years, although anecdotally, we're seeing longer holds right now. The company that we brought to them, they've now owned for 7 years and have not yet turned that around. But to be clear, the traditional private equity investor has to buy something knowing how they're going to exit because they have to get out soon. Okay, so that's kind of our second area. So you got venture capital, then you have sort of traditional private equity. Then another area is family offices. Well, family offices is indeed private equity, but family offices often can have buy and hold strategies. So what they often want is they want existing businesses that are cash flowing well that they can hold in their portfolio for a long time. They're not often raising money from outside people, although sometimes they do, but it's really a buy and hold mentality. And so this is really important as we found out about, well, we got a company that wants to sell. Well, what kind of capital group would mostly be interested in that? And so it's not only on these hold periods, but then it's also what sort of industries or types of companies do they like? Okay,
Yeah.
so one other one would be what they consider to be strategics, right? A strategic buyer. Is that maybe a competitor or maybe it's a larger company that wants to be able to consolidate? Okay. And a lot of times you can get better sales numbers being acquired by a strategic than you can often being bought by a traditional PE firm.
What do you suppose the biggest reason for that is?
Well, it's really about in order to exit right, you got to buy right.
Mm-hmm.
And so if you got to exit, not only do we have to buy right, but we have to improve the asset. So private equity wants to buy companies that can be improved.
Yep.
Maybe it's the 70-year-old owner that hasn't put a lot of money into CapEx, or maybe is working on old systems. So they got to be able to buy it right. Then they have to be able to improve it so that they can ultimately exit. If you have a strategic, for example, you might have all of the infrastructure and you're maybe just buying another revenue stream,
Yep.
right? And so if you can do that and you can reduce costs because you already have the infrastructure, and if you're not required to exit this in a pretty short time, 5 to 7 years is pretty short, then there can be more patient capital.
Gotcha.
Okay.
No, that makes a lot of sense.
Mhm.
And obviously every everything's going to be a little bit different, depending on the buyers and the groups and things like that. But typically, what type of assets are
Mhm,
these buyers looking to get into? What
mhm,
are some
mhm,
some things that, as our advisors are listening in and
mhm.
thinking, what types of assets, businesses should they be kind of keeping their ear to the grindstone on?
For sure. So let me answer that, but let me give you one more type of buyer. And this
I
is the
like it.
buyer that is mostly what we see every day. And that's going to be the owner operator. So what you have is most of the businesses out there are really lifestyle businesses that really count on the owner.
Yep.
And so it's hard often to sell that type of business, and it's almost impossible to sell that to an institutional type buyer, right? Because somebody's got to run it and there may not be enough margins. And so what I would tell you is anecdotally, 9 out of the 10 companies that you're thinking about that you work with is probably an owner operator type sale. Okay. But to your point, if you look out at the owner operators, they're going to be looking at maybe as low as $2 million of total revenue, right? If you've got $2 million of total revenue and maybe you even have a 10% EBITDA margin, you might have an owner that might be able to profit 200,000 plus their salary. Okay. If you're thinking about a small business owner earning $300,000 a year and having an asset that might be worth $8 million, dollars, maybe 4 times that top line, or maybe some other multiple if we're trading on EBITDA on that basis, that can be a reasonable asset. So you can get down into maybe the $2 million of top line revenue for owners operators. But you go into family offices, or you go into private equity, really the threshold that they're all looking for, and they'll come down, but what they're really looking for is $1 million in EBITDA. A
Okay.
million dollars in EBITDA and higher is what they're looking for. And what you see is that when that happens, you might trade at a 4 to 6 to 8 multiple, maybe 4 times EBITDA, 6 times EBITDA, 8 times EBITDA. Really depends on the market, and interest rates have a lot to do with this as well, especially in the private equity space. If they buy a company for $100 million, they might put $30 million in from their fund, and they might go borrow $70 million from the bank. Literally might be levered like 3 to 1. And
Hmm.
so, as you can imagine, the cost of capital, the higher that is, that actually shrinks their ability to exit. And so we've seen multiples sort of come down a little bit as well.
Yep.
Okay. One other thing that I would mention is that, at least anecdotally, most of the companies that I've been around there, they really like manufacturing companies better than people companies. The comment was, if your assets go home every day, that's not something that we're that interested in.
Yep.
What they're interested in is hard assets, right? And also the idea of artificial intelligence and other technology advances. No matter how advanced we get, someone or something is going to have to make this chair that I sit on. And so when you think about longevity, manufacturing, even if it goes completely AI, even without people, somebody's still going to have to own those assets. And I think, again, anecdotally, a lot of private equity people would much rather have manufacturing type firms than they would service type firms.
Yeah. No, that makes a lot of sense. I remember we talked about that in the past too, and it's like you said, if the assets are going home and going to sleep, they're not producing and getting that ROI you need in that 5 to 7 years. So
Correct.
definitely good to know.
Yeah. And so not only those types of companies, Steve, but then they want companies that are somehow special, right?
Hmm.
Now, special's not what does special mean? Well, special means what is special about that company? What's proprietary? Do they have any IP? Right? The more IP, the better. Right? What's the cost for switching? How saturated is their competition? Customer concentration is huge for valuation.
Yep.
Do you have 70% of your revenue in 5 clients? If you do, that is probably going to dramatically affect the value somebody's willing to pay because of the perceived risk of customer concentration. Right. They generally, especially the private equity tranche, they want strong management teams, because a lot of times they're coming in as the financial guys and putting together teams, but the company still needs to be run. So that can become a problem when Mr. or Mrs. Owner wants to exit. We go, well, you're going to exit, but then who is the management team? And so they're really looking for strong management teams that can stick around. And by the way, they incent these people by generally just buying a majority of the shares, but not all of the shares, so that there can be a second bite at the apple when they exit as well. And I've heard stories, at least 4 or 5 stories, where the second bite at the apple, that second sale, has actually generated more money for the owners than the first sale, even though the owners might have only had 20% in the new
Yep.
entity, if you will. Yeah.
Well, that makes sense. I mean, because they're motivated. They want to get another, just like any other incentive. I mean,
Mhm,
you want to see it grow. You want to see that second payday.
mhm,
Which kind of leads me into the next question I've got there, and you kind of started touching on a little bit. But as far as structuring the deals, I mean, outside of
mhm,
you talked a
mhm,
little bit about almost having a dual purchase, if you will, type of entity. Anything else you're
mhm,
seeing from a
mhm,
structure of these deals and how
mhm.
they're getting done these days?
Yeah. Well, I would say, especially again, if we look at the private equity buyer, the traditional private equity buyer, they want to buy at a value discount. And so they believe that every industry is cyclical. And so they're literally paying attention and they're putting together charts and they have research from all the smartest people in the world indicating where we are in a business cycle. And so very clearly and very obviously, they want to buy low and sell high. Well, how do they do that? How they buy low is they first of all try to pinpoint exactly the trough of an industry. Now, sometimes they're good at it and sometimes they aren't. We got to buy it at the bottom. Okay, that's number one. Number two, they can't overpay for it at the bottom. This is actually why my group was getting so much attention from these groups, because it's like, who's Rod Crandall and who are these guys and why do we care about these guys? Well, why you care about us is that we are service professionals that have connections into the small and mid-sized business that you want to buy. And without an introduction from us, what they have to do is they have to go through an auction process. And so what will happen is a company will want to exit. They'll hire an investment banker or maybe a business broker if it's smaller. And what they'll do is they'll bring that company to market and they'll go try to create a bidding war. One of the private equity executives that I'm friendly with, he says they want to show it to 100 of their closest friends. And so that's very good for a seller to be able to do that, although you do lose a lot of privacy perhaps in that kind of scenario if you're marketed everywhere. But I'm
Mm-hmm.
getting back to your question. I've got to buy it right. Part of buying it right is trying to avoid these auctions because what will happen is once money is raised inside of a fund, it has to be deployed. If the money is not deployed, which means we have to buy assets, if the money is not deployed, there's usually clawback provisions whereby they have to pay some of that back. And so they have to buy assets. And so what that means is that if they're shown to 100 people, you just need one firm that's willing to overpay. And so that becomes problematic. And that's the point about they're getting more creative in how they're sourcing deals. And an example of that is utilizing my group. So you got to buy it right. But now they have to buy it and they have to say, wait a minute, how can we markedly improve this company? If they can't markedly improve the company, even if they bought it right, they're not going to be able to exit right. So how do they markedly improve companies? Well, a couple of ways. First of all, they might be engaging in a roll up. I'm going to buy this company and I'm going to buy 2 other competitors and we're going to have one bigger company. That could be one way. They might be improving the management team, right? They might be including some IP somewhere, or they might have some vertical integration where they might have customers that they can plug in right away. Okay, so they got to buy it right, they got to improve the asset, and then they have to time their exit on the way out. I told you the one that we brought, they're 7 years into this thing. Now, I don't know when they're exiting, but I know they're preparing to exit. And I told you they bought this company for around 200 million. They are fully expecting $1 billion to $1.5 billion exit. Okay. Now, what you're expecting and what you end up getting might be two different things, but that is a scenario where they bought it at the right time. They have made multiple acquisitions and improvements, and now they're waiting for the right time to exit. Hope I
Wow.
broke that down okay for you, Steve.
Yeah. No, I mean, and again, you start, just hearing some of those numbers. It's just like in the insurance world. I remember we first getting into the business, and you hear about the large, the large state planning cases. Oh man, be nice to have one of those come across. Same thing in,
Mm-hmm,
in this world. It'd be nice
mm-hmm,
just to get a bite at the apple, like you
mm-hmm,
said. Find some of those PE opportunities. So you know, as we're getting, you know, kind of, you know, close to our time here, I guess,
Yep.
you know, one last question I've got for you, Rod, before we maybe see if there's anything else from the group. But, you know, what do you think? What does this mean for everybody on the call here? How, you know, what kind of action steps? What do you think as far as, you know, where we see this thing going and going from there?
Yeah. Well, you know, what does it mean for us? I think, first of all, you're going to see more consolidation in the industry, in the entire industry. I say one industry, all industries. And we're already seeing this. You're seeing it in insurance. People are aggregating. There is so much money out there in private equity. What you have is you have more money than you have deals. I just dropped something in the chat, a nice article that I read. There's 9 private equity firms. The top 9 private equity firms hold assets under management of almost $3 trillion today. Blackstone being at the top of this at 1 trillion. These are numbers from the end of 2023. Blackstone has AUM of 1 trillion. Apollo, AUM of 500 billion. And the Carlyle Group, 381 billion. So you have 3 firms that are almost at $2 trillion. And so you have a lot of what they call fresh powder out there. So you have more money chasing less deals. That means more consolidation. That also means that PE can be a real alternative to the public markets, and we're already seeing that. In fact, PE is buying a lot of public companies and taking them private. So that's a trend that I understand is a little bit different than it has been in the past. And then, of course, they're getting more creative in how they source, like I'm describing your group. So while I'm not formally doing that on a proactive basis any longer, I still have these relationships. And so it may be a little self-serving, but to the extent that you guys have a private equity or make that a company that may want to exit, we may be able to make an introduction. So it's something to keep your eyes open and your eyes and ears open. It sounds kind of gross, but one of the first things that was told to me by these guys was that a lot of people are selling their business because of heart attack, stroke, and cancer. And we're clearly in the insurance business. But what happens is you've got a proprietor that is running the business and it's a closely held business and they get sick. What you might find is they have not done the succession plan. And you might find that their management team is not that very strong. And you might find that they're in big trouble. And what they really need is a professional group to come in very quickly, buy the majority of the company, keep it alive, improve it, and help them exit on the way back out. So those would be just some things to think about as far as what does that mean to us, the average folks, if you will.
Yeah. No, I like it. Any final things you can think of that that you want to wrap us up with here, Rod, before we check and see if there's any additional questions from the audience?
No, not from my point of view. I hope that was meaningful for anybody out there. I'm ready to be open for questions or comments if anyone has any.
Yeah. No, I mean, speaking just for myself, I would imagine anybody that was paying attention definitely got some great value from what you shared. It really, I've heard it a few times, and I always pick up something new every single time I hear you talk on this subject. So appreciate you doing that today, Rod.
Thank you. It's my pleasure. Appreciate you.
So yeah, so we'll wait for any final questions. Put them in the chat box or unmute yourself if anybody in the audience has any questions. And while we do that, I just want to remind everybody that today's brew and our entire library of brews are recorded and shared on the brew page on our website, www.e4.insurance. So I'm going to give it a second here, check the chat. If anybody has any questions, feel free to type them in or come off of mute. Not seeing any, which means that you covered everything from A to Z, Rod, and clearly understandable and actionable way where we can take some headway with our audience here to get some action. So
beautiful.
Today's recording, like I mentioned, will be on our brew page. It'll also be emailed out to attendees later on today or early tomorrow. So now let's move on to our giveaway, Rod, and okay. In honor of that beautiful jersey I see hanging behind you, why don't you pick a number between 1 and 54?
All right. Well, then let's make it 9. 5 plus 4, 9.
Oh, there we go. Number 9, the lucky winner today, Adam Gallant. Congratulations, Adam. You're the winner. Be on the lookout for a complimentary CE voucher and Starbucks gift card coming your way from all of us here at E4 Insurance Services. We appreciate you tuning in today, Adam. So next week, we are going to have Tiffany Markarian, Managing Director for Advantis Marketing. We'll explore the complexities of selling a financial advisory practice. Whether you're thinking about transitioning out of the business or actively preparing for a sale, this podcast is designed to help financial advisors navigate the entire process, from valuing your practice and finding the right buyer to managing the emotional and financial aspects of the transition. Learn the factors and considerations involved in the succession process and how your operational strategy can affect the value of your practice. Hope everybody can join us next week. We thank you for attending, and we will see you next week on The Brew.
Thanks, everyone.